you hit a really important question for me, and it's the idea of, all right, if we think rates may come down, people might hear that and say, I'm going to wait till they come down. Should they wait, or should they buy now?
Right.
I'm thinking they should buy now, get the price down, because they can refinance.
Right, and that's exactly what I'm saying to people right now.
Okay.
We can talk about that, in terms of like, there's two different pieces to it. It's the rate piece and the mortgage piece. We can actually make this part. Is this being recorded now?
It is now.
Okay, yeah, it's cool. I mean, we can use this, right?
Yes.
So it comes down to the rate piece and the sales price piece, right? And a lot of people think that historically, when rates have risen, that prices have dropped, which has never happened. If you go back and look at the data, it doesn't exist.
Oh, wow.
That typically when rates increase, the reason why rates increase is because we have a healthy economy, maybe in this case, too healthy of an economy, and prices increasing rapidly, which is why the Federal Reserve is doing what they're doing right now to try to contain inflation. It's been 40 years since we've had that. But on the flip side, if you look at the last 30 years, each time when rates have gone up and when the economy has improved, prices haven't gone down. Prices actually continue going up because the economy is robust. People want to buy houses. They feel confident in their jobs, and they go out and they buy houses. The other side of this, which is, I think, a bigger piece of the whole underlying thing, is that when you look at it, the average median home buyer is somewhere in the low 30s, right? 33 years old or thereabouts is what our industry says. When you look at the population growth that took place and you look at the number of people turning 33 this year compared to the number of people turning 33 next year, compared to the number of people turning 33 in 2024 and 25, when you look at the numbers of the people that were born each year it was a significantly larger number of people that were born in this window for the next 4 or 5 years. So you've got households that are being formed, people who are getting married, people who are having kids, people who are kind of coming of age, so to speak, where it's now their time to buy a house. And they're going to buy them. They're either going to buy a house or they're going to rent a house. And with rents going up as much as they have, yes, mortgage rates are higher, and yes, the prices are higher, and yes, the payments are higher. But when you compare the house price, if you buy it, and compare it to what the same house would look like if you rented it, we're still in a position where very often the prices are going to be very similar, and then the buy ends up winning out, even with today's rates. We've talked about, what happens to rates and, what may happen in the future. One of the things that I'm encouraging all buyers to do right now is to choose loans that don't have a lot of upfront fees. So don't do a loan that has points with it. Don't do a loan where if you have mortgage insurance, we're going to front load the mortgage insurance. Do something where the upfront costs are minimized, because I think you're going to find that rates are going to drop again in the not too distant future. We've had now 5 periods of time in the last 15 years where rates, 30-year fixed rate loans on mortgages, have been down around 3.5% or below, like we've had the last several years. It's been quite a bit below that, but hit 3.5%. So if you're talking about rates that are at 5% or 4.5% or 5.5%, we hit, I think the average rate back 3 weeks ago was about 5.7%. Any of these loans are going to get refinanced. And so what we've seen also is a surge of requests for adjustable rate loans. I've done more adjustable rate loans in the last month and a half than I've done in the last 3 years. That being said, there's not as much difference between a fixed rate and an adjustable rate loan right now as there has been during historical, when you look at it historically. So some people are less incentivized to accept the adjustable rate loan, knowing that the rates can adjust, and also with the fear that, hey, what happens if the Fed isn't able to get inflation under control? Then do we have a prolonged period of time of increased interest rates, which I don't think is going to happen, but could.